Hi everyone, and welcome to the ORAH Fund's second Professional Investor Panel Series. It's so great to see so many of you logged into today's session, and we are really excited to be able to present such a great event today. My name is Carol Pillemer. I am co-founder of the ORAH Fund together with my husband Russell Pillemer, who will be the moderator of today's panel. The ORAH Fund launched December 2016 as a compelling investment fund of funds where 100% of all management fees are donated to charities which benefit the Jewish community. These donations come entirely from the exceptional fund managers you will hear from as part of the series and do not dilute investors' returns. Our aim is to create a sustainable asset for our community with a long-term revenue stream. It has been amazing to be able to provide support to so many incredible and worthy charities that are really making a difference to our community and to the lives of those who find themselves in need. Through the foresight of ORAH Fund investors in New South Wales and Victoria, and the generosity of our fund managers, the ORAH Fund should reach close to $1 million in donations by the end of the year, and counting. After attending our panel sessions, I'm sure you will agree on the impressiveness of the ORAH Fund managers and invite you to please visit the website orahfund.com.au and consider investing in a fund to do well and do good. With that, over to you, Russ, and our awesome fund managers.
Good afternoon, everyone, and welcome to the second in our series of ORAH Fund webinars. Today, we have the opportunity to meet and hear from 5 of our Australian fund managers. In addition to each of these individuals being great mentors who have provided their services free of charge to the ORAH Fund, they are each exceptional fund managers, certainly amongst the best in the Australian marketplace. And it is an honour to be able to showcase them today. It's great to have so many investors and prospective investors online today, and I hope and trust that you will find this session to be very worthwhile. Before we dive into today's presentation, I would like to take a few minutes to refresh your knowledge on the ORAH Fund. The basic proposition of the ORAH Fund is to provide investors with a compelling investment proposition, with a side benefit being that 100% of all fees are donated to Jewish charities. I stress that ORAH is unlike almost all charitable ventures in that we operate a zero-cost infrastructure where 100% of all of our expenses are provided pro bono, including investment management, administration, legals, accounting, and marketing. ORAH seeks to generate for our investors strong, long-term, risk-adjusted returns. That is, good, solid returns with a moderate amount of risk. We do this through, firstly, selecting underlying fund managers who are exceptionally good at picking stocks and building portfolios. And secondly, by combining our exposures to these managers in various weightings so as to maximize our chances of achieving our targeted returns. I'm extremely happy to be able to say that we have been fortunate enough to be supported by 12 exceptional fund managers. This includes some new additions that joined a few months ago and have already made a substantial contribution. The topic for today's webinar is the future of investing. This is a topic that is very close to our heart at ORAH, as we always pitch ORAH as an ideal long-term investment proposition. And if you want to generate strong returns over the long term, then it is imperative that you invest with fund managers who are particularly well equipped and prepared for the future. Our first panelist today is Katie Hudson. Katie is the lead portfolio manager of Yarra's Australian Smaller Companies Equity Strategy, which offers investors exposure to small size ASX listed companies. Over time, Katie's fund has generated returns that are significantly in excess of the index. Yarra Capital Management is a leading independent active Australian fund manager with approximately 8 billion of assets under management. The firm was established in 2017 following the buyout of Goldman Sachs's asset management business in Australia. In support of its deep commitment to fundamental research, ORAH has a large investment team of 19 professionals with an average 15 years industry experience. Katie, ORAH employs an active investment strategy. So how is the rapid rise of passive investing impacting your investment approach?
Hi, good afternoon, Russell, and good afternoon, everybody. It's a pleasure to be here with you today. Working from home, but working very effectively from home, I'm pleased to report. So look, in terms of the rise of passive, obviously that's a really interesting topic for active investors like us. We undertake detailed research. We do 1,900 meetings and channel checks a year to understand the companies that we invest in. So obviously the rise of passive investing, where people are buying an index essentially, is obviously something that occupies our mind, and is obviously something we think about in terms of the long-term approach to investing. It's probably worth paraphrasing a really well-known and very successful US investor, Howard Marks, on this topic, who said that the more money that's managed passively, the greater the inefficiencies there will be for active investors. And the logic behind that is that there's a circularity between passive and active investing. So the more money that goes into passive, the less there are the inefficiencies being undertaken by the active investors, and the greater over time those inefficiencies will be. So from our perspective, the money that's going into passive is actually serving to increase the inefficiencies from our perspective as an active investor, and from our perspective that's quite exciting. In terms of the Australian market, I haven't seen any data on how big the total investment in passive is today, but I have for the small cap market, which I participate in, and we think that's starting to approach the sort of high 30% or 40% of the market. So quite significant impact on that market. And how that's manifesting itself is very much in terms of short-termism, very much short-term trends being extrapolated. And from our perspective as a long-term investor, that's creating really significant opportunities for us to invest in some of those inefficiencies. I think 2020 will prove to be a year where we look back and say the rise of passive investing and the performance of active management actually was really strong on the back of the COVID disruption. And what we saw earlier in the year was a big sell-off in markets. A lot of the larger super funds were selling off, a lot of retail investors were selling at the same time. And in the small cap market, the small cap investors were buying at that time and have had very strong performance as a consequence through the balance of the year. So I think for us, very much around the inefficiencies that the rise of passive is creating, the focus that we have on long-term investing. We think around investing in quality businesses over a 3 to 5 year journey will only serve to benefit our investors as we stay focused on that long term and exploit the inefficiencies that are in the market and increasing over time.
Great, thank you, Katie. Our next panelist is Matthew Kidman. Matthew has been a professional investor for 22 years, previously CIO and CEO of Woodson Asset Management. Matthew co-founded Centennial Asset Management in 2015. Centennial specializes in small company investing using a bottom-up approach that is index unaware and has a broad mandate, including the ability to short sell and hold high levels of cash. Sorry, if everybody can just go on mute because I'm hearing some noises. Great. Since its formation, Centennial's flagship Level 18 fund has delivered superb returns. Matthew helped write 4 investment books and host the online investment show Buy, Hold, Sell for Livewire Markets. He has degrees in economics and law and a PhD in demography and finance. Matthew, I've heard you talk a lot before on the same topic about active versus passive investing. And so maybe just following on what Katie was saying, what are your views on this topic? And in particular, how is active investing being impacted by technology, which has redefined virtually every business around the globe, resulting in a few dominant players in each industry?
Hi, Russell. Thanks for having me on today. It's a good question because it's something the whole industry is grappling with at the moment. And I kind of think that what is happening is what is happening to every other industry, which is effectively technology has changed the rules. Once technology disrupts something, there's a consolidation, there's a handful of winners, and eventually that is the actual market. So listen to what Katie said before, and I'm in the stock picking game as well, but I don't see a great future, and it's been going on for the best part of 10 to 15 years now, for pretty vanilla type of funds, long only, index, above weight, underweight type of funds, and charging fees on the back of that. We can get that in a whole bunch of forms now. So I'm of the view, if we're at 30% in the small cap market, which Katie said that is index, which is more passive investment, that will continue to increase. You're going to have to come up with something completely different that offers a different opportunity. We've seen a number of managers do various things, such as neutral funds, such as we do. We can short, we can go to cash, and that works occasionally, but markets go up over time. So I think it's a losing battle, to be honest. I think the active management market is going to shrink. That 30%, whatever it is in the larger caps, I'm not sure either, but I know it's growing, will continue to grow, and there'll be just niche players left at it. I don't know how long it will take in other industries, as we've seen, whether it be just about anything, the likes of Google and other big technology companies, whether it be Apple and a whole host of different companies, have changed the way various industries have worked, and invariably there's only a handful of players that stay in business because scale becomes imperative. And I just can't see much difference in the investment market, even though it's happening at a slower pace, you would think.
Great, thank you, Matthew. Luckily enough for everybody in the ORAH Fund, we've got those managers who know how to invest differently. So you've come to the right place. Thanks, Matthew. Next panelist is James Williamson. James is CIO of Wentworth Williamson and portfolio manager of the Wentworth Williamson Fund, a contrarian value equity fund predominantly invested in Australian small caps. James has 25 years experience as an equity analyst and portfolio manager in Australia, South Africa, and Europe. He has experience through various market cycles, including the Asian financial crisis, the dot-com bust, 9/11, the South African Reserve Bank hiking interest rates in 2001 and 2002, the GFC, the China thematic over the past several years, and recently COVID-19. He has been lucky enough to have lived through several market challenges in various countries, and as such has a healthy skeptical opinion on many subjects, a critical skill for the successful contrarian fund manager that he is. So James, over to you. Value investing has been particularly challenging over the past number of years. Why is this so, and is there a place for value investing into the future?
Thank you, and good afternoon, everybody. Absolutely, and I remember during the late 90s as a young analyst, I used to watching something similar to what I've seen now in terms of the growth value thematic. And I sat around the table listening to revenue growth and no mention on profit growth for some of the darlings of the market. And I just accepted it. And everybody just accepts that price as it is, and the market is right. Well, I don't think that's true. I mean, we've certainly seen some thematics that have pushed that growth narrative. We've had interest rates stream down the last 10 years. And what that means is that for many, they're applying very low discount rates. So you could have a company that makes no money today with the prospect of possibly making a lot of money in the future, discounting it at a very low discount rate, and then getting these extraordinary, what we feel extraordinarily high valuations for some companies. We always try to think of a normalized environment, and for us, that's unacceptable. What I've seen in the past is that when the cycle changes, it changes incredibly quickly. Everybody asks me what the catalyst is. It's hard to say. There could be several, but when it does happen, it does happen quickly. And I think there's some warning signs. This has been going on for a long time. So yes, there's a place for value. I would say in the small cap area of the Australian market, there's not that many of us left. There's a handful of contrarian value managers, and there's an absolute niche for us. And we're a peak of the cycle, and possibly it may have just passed. So, yeah.
Great, thanks, James. Interesting stuff. Our next panelist is Mark Landau. Mark is the Joint Managing Director and Chief Investment Officer of L1 Capital. L1 Capital has been running its long-only Australian equities fund since 2007, as well as operating a long-short fund that the ORAH Fund has also invested in. Both funds have exceptional long-term track records. Mark, since March, you've been quite public in being very positive about stocks. I think you said that it was the best buying opportunity since the GFC. I'd be keen to understand why you went so positive and what your outlook is now for the market.
Thanks, Russell, and thanks for inviting us to be part of ORAH. We couldn't be happier to be contributing, and thanks everyone for investing. The charities are fantastic, and well done to Russell and the team. In terms of why we went so positive on the market, hopefully people would have seen we went and did a presentation on the 24th of March, which was within a day or two of the market lows. And we came out and told everyone this was the best buying opportunity since the GFC. And I think at that time, it looked like the world was ending and everyone was telling us we're crazy. And if you sort of step back and you think about what was actually happening in markets at that time, the vast majority of the selling you were seeing was not fundamental selling. And what I mean by that, it was people were selling not based on the outlook for the cash flows and earnings of these businesses over the long term. So you had retail investors panicking, you had redemptions across the market, you had margin calls, and then a lot of the parts of the market that you're probably not as familiar with, some of these quantitative strategies like risk parity funds and volatility targeting strategies, which are massive pools of money globally, which basically sell the market when volatility rises. And that just adds to the volatility and makes share prices detach even further from fundamentals. So we're a long-term fundamental investor. Yeah, as James was saying before, like, we're one of the dodos. We're one of the last value and contrarian guys out there. I think, long term, it's been proven over 100 years that that's a right strategy. It goes through periods where it underperforms and outperforms, but over the long term, it makes sense to buy stuff that is cheaper than where it's trading, what it's really worth. In terms of the market today, we're very positive on the market. So in our long short strategy, we're running about 110% net long, which is the highest net long we've had over the 6 years. And the reason for that, and to give you some context, we typically run around a 60% net long. The reason for that is that we think you've got this confluence of events, which is the most perfect backdrop you could basically get for equities. Other asset classes are giving you negative real returns. If you invest in bonds, if you invest in cash, you're basically accepting that you won't even keep up with inflation. In the case of central bank actions, you've got the most aggressive stimulus that we've ever seen, much more aggressive than even the GFC for monetary policy and fiscal policy. $100 billion deficit in Australia. They're talking about $2 trillion of stimulus from the US federal government. That's 10% of GDP just as a top up. And then you've obviously got multi-trillion-dollar QE from the Fed and other central banks. And then you combine that with the fact that we've now got confidence that the vaccine is going to work and that COVID is going to be a 2020 event, not a permanent event. So as you get into 2021, people are going to start to go about their lives again like they used to. And a lot of the sectors that were destroyed based on COVID are going to start to recover into the new year. So we think the backdrop for equities is absolutely fantastic. And there's still a lot of people that are very defensively positioned. They've been scared, understandably, because COVID was such a weird event. And we couldn't be more positive about the market.
Thanks, Mark. Always great to hear a positive voice. I'm sure you've made a lot of people feel happy today. And our final panelist is Rhett Kessler, CIO and Senior Fund Manager for the circa $900 million Pengana Australian Equities Fund, which he started in mid-2008. The Pengana Australian Equities Fund aims to enhance and preserve investor wealth over a 5-year period via a concentrated core portfolio of principally Australian listed securities. The fund seeks to generate consistent superior investment returns using fundamental analysis to select and own securities with the following characteristics. Firstly, good businesses with transparent and resilient models. Secondly, competent management. And finally, a favorable relationship between market price and future cash flows. The fund has an exceptional long-term track record of generating strong returns whilst preserving capital in falling markets. Rhett, a topic that is very much on everybody's mind at the moment, and that is, What is a dollar in any currency worth if every printing press globally is running at full speed?
Yeah, thanks. So first of all, can I say it's great to be part of this panel and to be part of the ORAH initiative. I feel privileged, particularly looking around at the people around me. So thanks very much for letting us participate. So to answer your question, if your purpose of investing is to either grow or preserve purchasing power of your money for yourself and your investors, it becomes a really real question that you can't hide in cash anymore, because every printing press is turned on. And so as we look around, I agree with Mark that you've got negative returns, particularly in cash. And I suspect, even though we haven't seen any sign of it, and every central bank will probably throw a party if we see any kind of inflation, because they're desperate for it, but I suspect inflation's coming. More importantly, is to preserve your purchasing power, you need to place your money in assets that will hold their value. And so I would tend to agree with this group that we have to seek out assets. And I can use a number of anagrams. You know, there's FOMO, fear of missing out. There's TINA, there's no alternative to equities, because every other asset class is giving no yield or no returns. But even within equities, I guess you need to make sure that you're in a place where you can preserve your purchasing power. And so we have decided to have a laser-like focus on what we're calling hard assets. So if money is demonetized or diluted by the printing presses being turned on, we should be able to preserve our value and even make some money. Now, I would agree that there's a whole range of equities in this bifurcated equity valuation environment that we have that are offering enormous value. And so while I agree with Mark that equities look really exciting, I think we have to be very careful where we go in that area. And certainly I think I'd probably agree with most of this panel that it's probably values time in the sun. We're ambivalent whether it's value or growth, but certainly when I look at my portfolio, there's enormous value on offer in value stocks rather than growth stocks, because the weight of money has been the other way for so long. And so it is an exciting time.
That's great, Rhett. I am excited. I'm sure all our listeners are as well. Let's move on to discuss some major trends. Mark, over to you. So you guys have done a huge amount of research on the various COVID-19 vaccines and treatments, and successfully positioned your portfolio back in June for vaccine success. What's the latest on the vaccine front, and how do you see the rollout impacting markets?
You've definitely timed today's event well, just given the AstraZeneca news overnight. So I'm going to give everyone a very fresh perspective on that. So hopefully people would have seen Moderna and Pfizer have come out with vaccines that were not only about as good as you could get on the safety profile, but also 95% efficacy. And, you know, back in June in our quarterly report, we talked about Pfizer and Moderna having a much higher probability of success than what the market was pricing in. And as you said, we positioned well for that, and we've had a really good period of performance on the back of that rotation. What people probably don't realize from the overnight news is that if you read the media reports or the broker research, you would see a 70% efficacy for AstraZeneca. So at face value, it's good, but it's nowhere near as good as the other vaccines. What people are missing is two key points. The first one is that there was a subgroup of patients that got a half dose and then a full dose of the vaccine. And in that subgroup, it was 90% effective. So there is a chance that if you follow that dosing regimen, you will get better efficacy than the 70%. More importantly, they weren't measuring like for like between the mRNA approaches, which is the Pfizer and Moderna approaches, compared to AstraZeneca. What people don't realize is that in the Pfizer and Moderna approaches, they had a much lower hurdle. They said to the people that got vaccinated, if you feel sick and if you think you might have COVID, go to your physician and get tested. There are a lot of people that get COVID and they're asymptomatic. So you would be positive for COVID, but you would not actually come out positive in the trial. In the AstraZeneca trial, what they did was they swabbed people. So they did a test every week. So you could have asymptomatic people that were coming up as being effectively a fail according to the trial, and thereby that lowered the efficacy. So we think that all of these vaccines are highly effective. What they've done is they've resulted in no one ending up in hospital if they got the vaccine, no one having serious side effects. So from our perspective, you've now got an incredibly bullish backdrop because you've got 5 billion doses of run rate production, about 1.2 billion coming from Pfizer, roughly 800 million from Moderna, and around 3 billion from AstraZeneca. And that's going to give people confidence that there is going to be an end to COVID-19. We're going to see a very rapid rollout in the US and UK. I think they'll be largely done by the time you get to April, and it'll be roughly mid-year by the time you're done in places like Australia and continental Europe. So we are very positive about the flow and effect of that. I think one of the things that's been funny is that people talk about the vaccine trade is over. You know, it was 2 weeks of outperformance for value and cyclical stocks. You know, much like some of the other panelists have been saying, you know, the time in the sun for growth stocks has been about a decade long. And we think that we're only at the very early stages of a rotation into some of these sectors that have basically been destroyed by COVID. So, you know, energy stocks, shopping centres, travel stocks, you know, there's a huge basket of stocks where the market caps are now tiny because people are pricing in Armageddon from COVID, but effectively we've now got the cure, and the only question is how quickly it gets rolled out. And I think people will be positively surprised at how quick this rollout ends up being. And to give you some comfort, we've done well over 100 meetings just on the vaccine and COVID-19. We've spoken to basically every person who matters globally. Our head of healthcare at L1 is a medical doctor. He's also Chinese born. A lot of the research was done with, you know, overnight meetings with people in China and people at Pfizer or AstraZeneca. And, you know, we didn't sort of come up with this idea on a whim. It was on the back of 6 months of, you know, massive focus from us internally.
Great, thanks, Mark. It's switching to geopolitics, Matthew. Australia's hooked its economic bandwagon to China. However, the political relationship between the two countries has soured recently. How does Australia handle a decaying relationship with our biggest trading partner?
Yeah, Russell. Well, it's quite good we have this question today, because we saw the Prime Minister yesterday accepting an award and trying to go to neutral territory, try to be Switzerland between the US and China. And I think they have to do that in a lot of ways, because the biggest issue for Australia and its market, its singular issue, is its relationship with China, both as a supplier of products and an end customer for our exports. And we're a large exporting country, both hard and soft commodities, education, tourism, a lot of things. And obviously China's become the dominant player in all that. And we've seen how it's been unpicked recently. It's been tit for tat. Australia has enforced some measures on China that they haven't liked. We've said things globally that they haven't liked, and they've responded, and it's starting to hurt. So it's a really difficult one. My kind of view is that what the government's doing right now and trying to get in the centre of the two countries and trying to be neutral and trying to say Australia's got its own agenda is probably the right path in the shorter to medium term. I don't think it's going to be easy. The Chinese will, you know, want our iron ore, and we can't be arrogant about that. We're one of the few suppliers in the world, because they're working in various places around the world to try and supplement that in some form and undermine us, because they don't like being dependent on one or two suppliers, Australia and Brazil. And then this year, Australia is one of the few places that is producing a lot of wheat. The wheat crop around the world is down. And Australia's had a bumper crop. So obviously everyone needs wheat, and Australia's one of the places we get it. So in the short term, we're probably okay. A lot of the damage has been done. We've got to move to the centre. I think in the long term, what we've got to do is two things: is foster relationships outside of China, especially in Southeast Asia. They're also in our backyard. There's people who need things. There's good growth. There's big populations. It won't be easy, but right around from India right through Southeast Asia, there's opportunity for us, and we've got to work really hard at that. And I think the ultimate goal is, and maybe not everyone agrees, especially socially, is that what we've got to try and do is grow our own country. I mean, you look at America and the size of its population, it doesn't depend so much on trade. What it depends on is its domestic consumption. And Australia's got to work towards that over the very long term. We've got to build an economy where if you've got a product, it can be made or it can be sold in Australia and get enough scale to make it work. We just don't have that a lot of the time. We've got to go off overseas, and that is undermining. So I think in the short term, foster other relationships, play the middle ground, and in the long term, grow the country like we were. COVID's obviously put a dent in that, but to pick a side at this stage, and no matter what happens, would be very, very difficult for Australia. And we've seen it already, a taste of what can happen. I'm sure it can get a lot worse.
Thanks, Matthew. There certainly are challenges that we as Australians are facing in the coming years. But Rhett, I often heard you talk about Australia being the lucky country. Why do you think that's the case?
Yeah, well, I count myself lucky to be here. I think I've won the lottery ticket to end up in this country. And for a number of reasons. I mean, the ones I'm referring to, I guess, when you ask the question is economically. I think the fact that we can pull iron ore out of the ground and drop it off on a ship and make sure that people pay us for it before we let the ship disembark or leave the port. And it costs us $10 and we're sending it off at 120. And it's our biggest single export, makes us very lucky. It's also interesting, I think, that if we weren't the lowest cost scale producer, that would have probably been dragged into some of the negotiations or displeasure that China showed us. But I guess they can't because we have the power in that sense. I also refer to the comments Matthew made about at a time when the wheat price for us, so the spread's really big, we've produced one of our biggest crops ever. And then the third one is, I find pretty amazing, is that I thought that we would be hurt quite a bit by the lack of tourists, incoming tourists and international students. And a bit of research has shown that Australians spend more money traveling overseas than those other two industries combined. So net, we seem to be better off domestically yet again. And then I guess the third one is the very low debt to GDP. So at a time when we're exceptionally, when the world's under quite a bit of stress, I think we're exceptionally well placed. And I think back to, before my time in this country, when in the 60s, there were big projects where the country took on massive projects like the Snowy River hydroelectric power station. They brought over a whole village of people and populated Griffith to build our wine industry. And given the safe haven that Australia now represents globally, and maybe including New Zealand in that, it would be quite ambitious, but I think quite doable to think about bringing whole villages of specialized manufacturing expertise over from, maybe Northern Italy or Southern California. But I'm sure if we had an initiative at a government level, we could fix some of our shortcomings in that specialized manufacturing area. So it's a time that we've got enormous resources. The balance sheets are strong. We've got an incredible brand here, and I think it's time to be very happy living in this country. Thanks,
Rhett. So James, on that topic of resources, you're a person who has fantastic expertise in resources. You're also known for your strong conviction to maintaining your investment methodology. So tell us this: in such a fast-changing world, does it actually make sense to maintain your conviction?
Yes, I'm going to go back and I'll tell you a story. It's a true story. And it's quite short, so it might help explain things a little bit. But two of my mentors have passed away. So it's the late Alan Gray and the late Simon Murray. And I was fortunate when I left Australia in the late 90s, and I spent some time in South Africa and had exposure to these gentlemen. And I've seen this story. I don't know if you're aware. Alan Gray, at the time of his passing, was the richest guy in South Africa, was worth several $1 billion. But in the late 90s, he lost every single client of his bar one. It was a clothing retailer. It almost went bankrupt. I remember on the radio stations, they were saying things that you are saying to me now, right now. And it was almost like, oh, guys, you're old-fashioned. there's technology, it's changing the world, what are you doing? And they were being seemingly left behind like dinosaurs. And of course, as I said before, when it flips quickly. And those clients came back, and it basically set up that business where Orbis Global today is one of the largest value fund managers in the world. So yes, you can't do drift. You have a methodology where you focus on cash profits. You're always looking at a world that eventually normalizes. You must stick to what you are and what your beliefs are, because it does come back. You can go back to that time in the late 80s, 2006, 2007. We know that you go through these periods. I mean, this has been the longest it's been in history, but that makes it even more compelling that you stick to what you know, and focus on cash profits and not paying excessive prices for market darlings. So, yeah.
Great story. Thanks, James. Katie, switching to you and switching topics somewhat. You're an expert in the small cap sector. How has that sector performed during the COVID crisis and the rebound? And what are your expectations for small caps into next year?
Yeah, thanks, Russell. So obviously with, look, small caps tend to perform like a risk asset. So equities is a risk asset. Small caps tends to be a riskier part of that portfolio. And so as you can imagine, against that backdrop, the small cap sector fell hard in COVID, but it's rebounded stronger as risk came back on. So to put that into context for you, from the February peak to the March trough that Mark referenced earlier, the small cap benchmark fell 40%, but it's rebounded 65%. So a really big rebound, and is now up over the course of the year 5%. So you might ask what crisis, given the small cap sector has actually rebounded to be above where it started the year. Quite incredible. Today, the small cap benchmark is trading about 10 to 12% cheaper than the large cap sector. That's pretty much in line with long-term trends. So there's no obvious sort of valuation gap there. But what I would call out in terms of how we're thinking about small caps for 2021 is they tend to have more exposure to the Australian domestic businesses and industries. So when Australia is outperforming, the small cap sector tends to do better. And against that backdrop that some of my colleagues have been describing of a better health outcome and a better economic outcome for Australia, and as Rhett just described, Australia being in a really relatively magnificent place, we want to be overweight Australia, and small caps tends to be a good way to do that. I would call out though within that there's pockets of overvaluation. Some of the guys today have talked about some of the technology stocks. I think I'd talk about some of the healthcare stocks as well in that. And I'd also call out some of the retailers today over-earning on the back of at the back of the COVID rebound, on the back of cost benefits they've had and subsidies they've had from either the government or rent. We think there's some areas in those three sectors that are over-earning, but overall we're finding really a lot of really compelling ideas to invest in the small cap sector at the moment, and on the basis of that, we're really optimistic about 2021.
Thanks, Katie. So Matthew, on the topic about the future for the coming year, so there's a major debate as to whether the COVID bear market triggered a new secular bull market or not. Are we in a new market cycle, or lurching towards the end of the one that's started post the GFC?
Yeah, that's an interesting one, Russell, because a lot of commentators have said that we've had a massive recession, one of the sharpest ever, if not the ever, and one of the shortest ever. So it's unusual. Equity prices got smashed. It was probably most akin to what happened in '87 when the crash happened. The crash was more in one day, but in virtually, it was just under 5 weeks. We lost all that ground that Katie talked about before. So in the short term, so we're going to work out whether this is just a rebound on a trend that was in existence since the bottom of the GFC, because the last structural bear market we had was the GFC, which lasted 16 or 17 months. And we know it took markets 50% lower. Or is this the beginning of a new secular cycle? If that was the case, most secular bull markets will run, in history, they've run from 8 to 18 years. It's a long time to go. My personal view is it's not. I think this is an opportunity, and I endorse what the other panelists have said and how Mark outlined why it's so bullish for equities today. However, I do think that it will be a very, very quick recovery now that the timeline's been put in place with the vaccines coming to, the vaccine results being positive. We've kind of got a timeline now of how it will work. We've got governments who are going to stimulate in Australia. We've got a federal government that is facing an election at some stage, maybe the back end of next year, early 2022. They will want to keep the foot to the floor. So I think what we're heading to here is not the next big secular bull market. I think this is a final leg that may last 2 or 3 years because we've got a lot of excess capacity. I think the rebound will be very quick. It could be for 2 or 3 years, and that will round out what began in I think it was March 2009 when the market bottomed. That would mean we're it's 13, 14, 15 years in that kind of category of a secular bull market. That is not unusual. I think Australia in these next couple of years has got a long way to go. It might sound strange. We still haven't really got over. In terms of prices, I know the accumulation index is well above when you take into account dividends, but just on share prices, we're not really above where we were in 2007, November 2007, when we peaked. So I think we could actually travel up a lot over the next 2 years. And we might actually even get into, with all the stimulus, with the recovery in earnings, with companies cutting their costs, I think things could go into overdrive over the next couple of years. We could end up in a silly phase at some stage, maybe 18 months away, where stocks are going up for reasons that we can't explain. For the moment, we can put it on fundamentals, but I do think that will take us to the end of a secular bull market that started in 2009 rather than one that will last the next 8 to 20 years from the moment the market's turned this year, in March this year. Where can we get to? I don't know, but I would have thought that with interest rates where they are and with the stimulus where they are and how margins will expand because of all the cost cutting, that we could end up 30-40% higher than where the last peak was, which is, or peak in the bull market, which was around that 6,800 way back in 2007. So we could end up at the 10 or 11,000 mark. But I think that will do us, and that's not an unusual structure for a secular bull market to play out.
Well, I will certainly take that if you offer it to me. Certainly take it any day. Thank you. James, what are your thoughts on that? What sectors are you positioned in now, and what areas are you avoiding?
So I'll do the avoiding ones first, because for me that's very easy. So the market darlings. I completely avoid those things like Afterpay. It's a market cap of 30 billion. It's half the size of ANZ Bank. It really, if you take all costs into account, it makes no money. And over a long period of time with increasing competition may not make anywhere near what people think. ANZ Bank on normalized earnings can make $6 billion per annum. I just don't get that. If I look at the healthcare sector, CSL, it's trading on about 50 times earnings. You don't have to go back very long to see that stock trading just over 20 times. So there's been very significant multiple expansion there. So I think that's dangerous ground. A third one is, and this is a large part of the market, I wouldn't like to be directly exposed to iron ore prices. And there's no question that they are relatively high compared to history. I think one of the panelists mentioned that there's some other countries that are going to get their supply, Brazil and places of Africa. The Chinese will do what they have to do. There is going to be increase in supply, and we're talking about vaccines for COVID. They will get their supply sorted out. So those I would avoid. In terms of where to go, there's no question that the best value in the market is in small cap industrials. We are looking at others, and I want to say infrastructure, but I think it would be a little cleaner than that, not big projects, but we've got a company that does modular building, significantly underpenetrated in Australia. company like Fleetwood. It's got a significant net cash balance sheet. It's been completely forgotten about. If you go back several years, it was $12. You know, it's just over $2 today. These companies have been completely washed out. Another one is SRG Global, a business that does cladding, dam remediation, bridges. Again, completely washed out, constantly announcing more contracts, huge amount to work on, but just under that index and completely forgotten about. BSA, NBN maintenance, same thing, strong balance sheet. These are all, if you look at it on a normalized basis, 10 times multiple companies, and again, I stress strong balance sheets. Perhaps even, and then the recovery ones, Surf Corp. Poor old Alf, he hasn't made a loss since 1978, even the worst of time. The guy knows how to make money. And everybody said he's also old and it's going to be, his business is going to struggle when Regis deployed so much capital and WeWork, and yet his business still continues to do well, paying a 6% per annum dividend in the worst of times. So there's the COVID recovery stocks, and there's some that just been left behind and just underneath the radar. So this is where I think the most money is going to be made over the next couple of years.
That's really interesting. Thanks, James. Rhett, I've heard you talk about your focus on hard assets. You mentioned it earlier on. What are these hard assets, and is this where you're investing for the coming years?
Thanks, Russ. So hard assets for us are companies that have pricing power due to their assets, which can either be contractual, scarce resources, bricks and mortar in the ground, etc. And an example, I guess, of this would be, this is probably the first time that we've had almost 10% of our money in the real estate sector. So some of it's probably being contrarian, but I'd go along with what James has been saying. You've got some companies like a Mirvac, which has a track record over many years of being the best, diversified property manager. Different parts of the group pick up the backpack, as they call it, and carry it along. It's certainly its office portfolio is under a cloud, because obviously no one's ever going to go back to an office. And trading at a 45% discount to what it cost them to build these offices was too appealing. And so this is a hard asset, which for us, even at a depressed earnings level, can throw off cash and represent some scarcity, given their land bank, their residential development capabilities, and their superior offices that we think can be monetized. Another one within the same category would be a Waypoint REIT, which, if any of you remember, used to be the Alviva REIT. And essentially what you're doing is you're lending money to Coles and Shell. So you own you're the landlord for all the petrol station forecourts. And what I love about this business is that you can buy it on a 6% yield, growing at 3%, 11-year whale. And the best part for me, because I'm an ivory tower guy, is that it's triple net leases. And so we constantly hammer management as to why they need 5 people in the company to pick up the checks and then pass them through to us. And so these are contractual assets that we think will withstand the test of time. Now, they might not be that sexy in the big vaccine recovery, but you have to balance your portfolio. And so you have some that carry the backpack in our talk during the times when things get a bit rocky. And then you've got to have something like a Mirvac that can pick up the slack when it becomes obvious that people will be going back to offices, and that people will continue to emigrate into Australia. And by the way, we seem to have really good authority, really good evidence that there's going to be a baby boom early next year. Pregnancy pathology tests have gone through the roof. And believe it or not, that we might even be extended, because private healthcare insurance has suddenly picked up quite sharply which only happens when people are planning to have babies in the next year, because there's a year exclusion. So I think there'll be about 300,000 babies. Normally there's going to be 340 if anything, the pregnancy tests, anything to go by. And so for that, you need things like homes and hard assets. So there's a big mixed jumble. Unfortunately, there's some downsides from having to spend all that time together, but this is probably one of those positive ones.
That's great. Thanks, Red. And then Katie, just once again, switching topics on you. ESG investing is something that's become very popular and very talked about. How do you find ESG changing the nature of investing?
Yeah, thanks, Russell. So I talked before about how we think passive investing is one of those themes that's having a big impact on pricing and markets. We think ESG is absolutely another one of those. As you think about ESG, for those of you who aren't familiar with it, environmental, social and governance risks. For us, ESG is an important part of the risk analysis we do on every company and industry we invest in. And I think 2020 is one of those inflection point years around how ESG investing is impacting markets and pricing. So for us, when we think about it, it's, as I said, it's a long-term assessment of industries and around risk. And in the past, we used to find it to be 2 or 3 years before the market started to price in some of those risks. When it thought about how the market thought about that risk and when it started to care about it. In 2020, what we're observing is ESG factors have gone into overdrive, with large amounts of capital now prioritising ESG considerations in their investments. And I'm thinking about industry super funds who have long cared about this. I think we're seeing large amounts of capital feeding into it. That feeds into their fund managers who also care about it. It also feeds into a number of ESG specific funds and impact investing funds that are now emerging and starting to impact pricing around these assets. So what does it mean? I think what it means is the pricing of these risks is happening a lot faster. So if I think about what I'd call the ESG losers, so those sectors where people are going to try and avoid the ESG risks, we're seeing pretty significant increases in their cost of debt and their cost of equity as investors pricing that risk. For 2020, that was coal. So what we're seeing is coal now seeing much higher cost of debt, much higher cost of equity for the assets associated with the coal sector. And that feels permanent. There's also a risk, I think, that the ESG winners will become overpriced, and we're watching that. So I'm thinking about maybe recycling, renewables, and those sort of sectors, I think, where people see there'll be ESG winners. Over time, there's some risk that they'll be overpriced, but certainly for us, continuing to focus on the ESG winners, continuing to think about how ESG risks are captured in the companies we invest in, will continue to be a very important part of how we invest for the long term. But I think it's very much front of mind now, and there's been a massive acceleration over the last 12 months. I think that continues as we go forward over the next 2 or 3 years.
That's great, thanks. So we're almost out of time, but before we finish off, I'd just quickly like to go around the panel and ask everybody if they can just focus for 20 or 30 seconds on one particular stock and why you've got it in your portfolio. And just some food for thought to end off on. If you can please keep it sub 30 seconds. So Katie, why don't we stay on you? You started off.
You're asking me impossible as fund manager to talk about a stock for 30 seconds. It's literally impossible. So I'm going to mention one that some of my value peers might think is expensive, but I'm going to talk about a company called Nanosonics in the medical device sector, supporting disinfection of medical devices. They have a lot of the things we love about companies: global market, recurring revenue, net cash balance sheet, outstanding management, and lots of opportunities to reinvest their strong balance sheet into growth options. So that's one we think will be a very long-term winner over time.
Okay, great, fantastic. Mark, over to you.
The stock I'll pick is Safran, which is listed in France. It's the world's best quality aerospace company. Basically, if you've ever gone on a narrow body Airbus or Boeing plane, 60% of the time it'll be a Safran engine that'll be flying that plane. The reason it's such a good business is because once they have that sale, they basically have a monopoly on servicing and parts for the next 30 years. So the best analogy I can give you is like you got a Gillette razor and you are stuck with that Gillette razor and you have to buy the blades from that company for the next 30 years. And every year they put their price up 5 to 6%. Their main competitor has a much less reliable engine. They have the youngest fleet in the market. It's obviously been hit dramatically by COVID. The shares fell from 150 euros down to 60 back in March. We were buying aggressively. And even at today's price of 120 euros, we still think there's close to 50% upside on a 2-year view.
Awesome.
So that's our favourite.
Thanks, Mark. Matthew?
Yeah, Russell, the one I like is whether COVID or not, recession or not, is a niche business that's got global markets. And we think that one of those stocks is Bid Energy. Bid does electronic billing for money for enterprises. They're in Australia, New Zealand, in the US, and now in the UK. So they've got a global footprint. They use their electronics and their AI to bring in bills, make sure they're correct, pay the right bills, and then go out and also find other areas where utilities, whether it be energy, water, whatever, where they might be cheaper. They've got traction. COVID hit them in the US, where companies put off a lot of things, including looking at how to reduce your utilities bill. They've got traction again. I think it can grow for a long time to come. It's on the verge of becoming profitable. It's not cheap. You will grow as the earnings grow going forward. So BID is the code.
Great. Thanks, Matthew. James, over to you.
For me, it's Fleetwood. A third of its market cap's in cash. Its PE multiples about 10 times. It's the market leader in Australia in modular buildings, and you only need to look to see what the government's going to spend on social housing, prisons and schools to see that the opportunity is there for them. It's fair to say that some of the managers in there have played an active role in some change management. So I say going forward, that company's in a prime position and exceptionally cheap too.
Great. And finally, Rhett, your pick. You're on mute, Rhett.
Okay. I'm not sure whether to choose something like Telstra or an SG Fleet. Both are very controversial. I'll do Telstra. So, yep, really boring stock. No one likes management. 45 cents is the mobile phone network, which is the best mobile phone network in the country. Ever try to take Wi-Fi or phone away from a teenager? You know, it's the new oxygen. And then 40 cents in the dollar is an annuity stream from the government that, believe it or not, is linked to inflation. So I think it's under earning at the moment. Buying these businesses on a 16 PE with a 5.5% yield, certainly not sexy, but it's okay. I'll take that. That's my pick.
Fantastic. Okay. Well, that's been really fantastic, I must say. You know, just a wonderful session. Thanks to the managers, for being with us today and enlightening us, but also, you know, for your invaluable contribution that you make to ORAH. It's allowed us to do so many great things and to help so many people in their lives. To you, the people who've joined the call to listen today, whether you're investors or not investors, thank you so much for your attendance. To the investors, thank you for your contribution to ORAH. And to those people who are contemplating becoming investors, we encourage you to take a strong look and hopefully to invest. Thank you, everyone, and have a great week. Cheers.
Thank you, Russ.
Thanks, Russell. Thanks.